Hello everyone, welcome to Tesla Daily News. Today is May 28th, Thursday, and the following is the latest Tesla news. According to recent market data, Tesla's stock closed at $440.36, up from the previous close of about $433.59. Intraday trading saw a high near $445.60 and a low around $435.52, on volume of roughly 44.5 million shares. Technically speaking, strong bullish candle, heavy volume confirms upside momentum. For long-term investors, this move reinforces the view that markets are looking past near-term volatility and beginning to price in Tesla's artificial intelligence, energy, and robotaxi optionality more aggressively. Short-term traders will be watching whether the stock can hold above the recent breakout area and convert it into a new support zone. According to NDTV Profit and NI News, chatter is rapidly growing about a potential merger between SpaceX and Tesla, as SpaceX moves toward a blockbuster Nasdaq listing under the ticker SpaceX. SpaceX has filed for an initial public offering that could raise around $75 billion at a valuation in the ballpark of $1.7 to $1.8 trillion. Both reports emphasize that Elon Musk has discussed, at least informally, the idea of combining the rocket company SpaceX with the electric vehicle and clean energy company Tesla. From an investor's perspective, the key point is synergy, especially in artificial intelligence and compute infrastructure. SpaceX, which now includes the Xi Artificial Intelligence Unit, reportedly spent more than three-quarters of its $10.1 billion in first-quarter capital expenditures on AI. Tesla, for its part, has guided that its own capital expenditures could nearly triple this year to around $25 billion, largely to expand dojo, data centers, and autonomous driving capabilities. A potential merger would concentrate two enormous AI and robotics platforms in one publicly traded entity, potentially giving Tesla shareholders indirect exposure to Starlink, launch services, and Xi at scale. Board-level overlap reinforces that this is more than just speculation. Elon Musk and venture capitalist Ira Ehrenpreis serve on both boards. Musk's brother Kimball previously sat on the SpaceX board and now serves on Tesla's board. Former Tesla directors Antonio Gracias and Steve Jurvetson sit on the SpaceX board today, and Charles Kaman is vice president of materials engineering for both companies. Tesla has already invested about $2 billion into Xi, which has since merged into SpaceX. For Tesla enthusiasts, the upside vision is a combined AI, energy, mobility, and space infrastructure company with unmatched vertical integration. The risks are equally real: governance complexity, regulatory scrutiny, antitrust questions, and the challenge of integrating very different capital structures and risk profiles. For now, investors should understand this as a medium-term strategic possibility, not a done deal, but one that could fundamentally reshape the Tesla equity story if it ever moves forward. According to the South China Morning Post, Xiaomi is directly targeting Tesla's Model Y in China with a new low-cost SUV called the Yuqi. Xiaomi has begun deliveries of the standard edition Yuqi, priced from about 233,500 yuan, roughly $34,400, which is about 30,000 yuan cheaper than the refreshed rear-wheel drive Tesla Model Y. Xiaomi's president Lu Weibing claims that in configuration, driving range, and technology, the Yuqi beats the Model Y across the board. The same report notes that Xiaomi's earlier SU7 sedan has already outsold Tesla's Model 3 in China, with April sales of about 26,826 units. That performance helped push the Tesla Model Y down to the second best-selling model across all powertrains that month, behind the Geely Xingyuan. Tesla's Model Y sales in April reportedly dropped 42% month-on-month to around 22,990 units. For Tesla investors, the message is clear. Chinese domestic competition is not only intense in sedans but now ramping hard in the crossover and SUV segment that has been Tesla's volume and margin anchor. Xiaomi is leaning on its consumer electronics playbook: sharp pricing, tight integration with smart devices, and aggressive software and AI positioning. At the same time, broader Chinese electric vehicle demand is under pressure, with overall EV retail sales falling about 17% year-on-year in the January through April period. That backdrop is hammering margins across the industry, including at domestic leaders like BYD and Geely. For Tesla, this environment likely means continued price pressure and strategic trade-offs between volume and profitability in China. The competitive threat from Xiaomi underscores the importance of software revenue, full self-driving monetization, and exports from Shanghai to higher-margin markets. Long-term, success in China will depend on Tesla's ability to innovate on efficiency, reduce bill of materials cost, and differentiate on autonomy and ecosystem value rather than hardware alone. According to Dünya Gazetesi in Turkey, electric vehicle sales in Europe are surging again, and Tesla is showing early signs of a rebound in the region. New data from the European Automobile Manufacturers Association shows that European Union new car registrations in April grew a bit over 5% year-on-year to about 972,000 vehicles. Within that, fully electric vehicle sales jumped to nearly 38%, vastly outpacing the broader market. Tesla's sales in the European Union in April reportedly rose more than 67% year-on-year to roughly 9,169 vehicles. That lifted Tesla's market share from about 0.6% to close to 0.9%. Over the first 4 months of 2026, Tesla's EU sales have grown more than 61%, while fully electric vehicles as a category gained share from about 15% of the market to nearly 20%. Tesla investors should see this as an important regional counterweight to the headwinds in China. After a stretch of relatively weak performance in Europe, Tesla appears to be regaining momentum as the overall EV transition accelerates. At the same time, Chinese manufacturers such as BYD, Chery, and SAIC's MG are rapidly increasing their European volumes, in some cases more than doubling or quadrupling sales year-on-year. That means competition will remain intense, and regulatory factors like tariffs and local content rules will play a bigger role. For Tesla, Europe offers a growing addressable market, but not an uncontested one. Efficiency, manufacturing scale in Berlin, and regulatory compliance, especially around safety and software, will be critical levers. According to Zogla in Greece, Volvo is expanding access to Tesla's Supercharger network for its fully electric models, both in Europe and in the Asia-Pacific region. Starting from the fourth quarter of 2026, Volvo drivers in Europe will be able to use the official Volvo app to charge their electric vehicles at more than 20,000 Tesla Supercharger stations across 29 European countries, including major markets like Germany, France, the United Kingdom, Italy, Spain, and also Greece. This builds on existing access to superchargers in North America and significantly strengthens Tesla's position as a de facto charging standard. For Tesla shareholders, every additional automaker that integrates with the supercharger network potentially adds incremental revenue streams from charging fees, improves station utilization, and solidifies Tesla's bargaining position in future infrastructure negotiations. Even as non-Tesla vehicles use the network, Tesla can maintain a technology lead in reliability and speed, and leverage that reputation to support its own vehicle sales. Strategically, this also shows Tesla evolving from a pure automaker into a platform provider for charging, energy, and eventually software. The more that rival automakers rely on Tesla's infrastructure, the harder it becomes for them to differentiate on charging experience alone. For Tesla enthusiasts, this is a sign that the company's early bet on building a proprietary fast-charging network is paying off across multiple regions. According to Interia Motoryzacja in Poland, Tesla's upcoming robotaxi-oriented Cybercab could represent a major breakthrough in electric vehicle efficiency and cost structure. In a farewell event for the Model S and Model X, Tesla's Vice President of Engineering Lars Moravy reportedly stated that Cybercab targets certified energy consumption around 165 watt-hours per mile, roughly 10.25 kilowatt-hours per 100 kilometers. If those numbers hold, Cybercab would be among the most efficient electric vehicles on the market. Most current EVs consume in the range of 15 to 20 kilowatt-hours per 100 kilometers, with larger SUVs above 25. Tesla believes that with Cybercab's ultra-low energy consumption, it can reduce battery capacity by roughly one-third compared with current models while maintaining similar real-world range. Analysts suggest that a battery pack on the order of about 40 kilowatt-hours could deliver range comparable to a 60 kilowatt-hour Model 3, with some earlier hints of even 35 kilowatt-hours being technically possible. For investors, this matters because battery size is one of the biggest cost drivers in an electric vehicle. Shrinking the pack by a third, while keeping range steady, could significantly lower vehicle cost, weight, and charging time. Tesla expects Cybercab to charge up to 50% faster than a Model 3 for similar charging curves, meaning more trips per day for a given robotaxi asset. That plays directly into the economics of an autonomous ride-hailing network, where uptime and cost per kilometer determine profitability. Cybercab's design has reportedly prioritized aerodynamics and efficiency over traditional comfort and styling. The body shape, low ride height, and seating position are tuned for minimum drag and energy use, not necessarily for conventional driving enjoyment. Some experts caution that the impressive consumption figure may apply primarily to urban test cycles rather than mixed highway use, which could reduce the headline improvement from a revolutionary 30+% to perhaps only a mid-teens gain. Even so, any material efficiency advantage can compound across millions of fleet vehicles. For Tesla shareholders betting on robotaxis and mobility as a service, Cybercab's efficiency claims are a key pillar of the long-term margin story. According to News.com, a viral video from Sydney has reignited the safety and regulatory debate around Tesla's full self-driving, now branded as full self-driving supervised in Australia. The clip shows a man in a white Tesla apparently sleeping behind the wheel while the car travels down the M2 motorway. Another driver honks and yells for him to wake up, and the Tesla driver quickly stirs and gestures apologetically. The article emphasizes that despite its name, full self-driving supervised is legally treated in Australia as a Level 2 driver assistance system, similar in principle to adaptive cruise control plus lane keeping. The system can steer, accelerate, brake, navigate intersections, and change lanes in some conditions, but the human behind the wheel remains fully responsible for monitoring the road and taking over at any time. Australian authorities, like their counterparts in the United States and Europe, are clear that this is not a license to sleep in the driver's seat. For Tesla, these incidents highlight the ongoing branding and communication challenge. The company argues that its in-car prompts, steering wheel torque checks, and in-cabin camera monitoring are sufficient to enforce attentive driving. Critics counter that the term full self-driving, even with the word supervised appended, encourages some users to over-trust the system. For investors, regulatory risk around advanced driver assistance remains a non-trivial factor. Investigations or restrictions in key markets could slow deployment, increase compliance costs, or delay the realization of high-margin software revenue from autonomy. At the same time, many users report that full self-driving is already very capable, particularly on long highway drives, in construction zones, and around unpredictable pedestrians or drivers. The commercialization path will balance those enthusiastic user experiences with the need for strict oversight and standardized safety metrics. The Sydney incident serves as a reminder that, for now, Tesla's autonomy remains an advanced driver aid, not a fully autonomous chauffeur. According to HNA in Germany, a Tesla Cybertruck owner in Texas dramatically misinterpreted the vehicle's off-road capabilities, driving his truck directly into Grapevine Lake in an attempt to demonstrate that it could float or operate like a boat. The driver reportedly said he wanted to test the so-called wade mode feature, which is an official Tesla function designed to help the Cybertruck traverse shallow water such as rivers or streams. However, Tesla's own manual clearly limits wade mode to water depths up to about 82 centimeters, measured from the bottom of the tire, and speeds between roughly 2 and 5 kilometers per hour. In this case, the driver drove into a much deeper lake without properly checking depth, and the Cybertruck quickly became inoperable and filled with water. The driver and passengers escaped, and local firefighters had to tow the vehicle out. The Grapevine Police Department arrested the driver, citing multiple potential charges and stressing that just because a vehicle may be technically capable of crossing water does not mean such stunts are legal or safe. For investors and enthusiasts, this story is less about fundamentals and more about brand perception and liability. Cybertruck is marketed as an extreme, durable, off-road capable vehicle, and features like wade mode and comments about temporary boat-like behavior can encourage some owners to push beyond reasonable limits. When incidents like this go viral, they can draw regulatory and public scrutiny, particularly around how Tesla communicates capabilities and limitations. While one reckless owner does not change Tesla's valuation, a pattern of high-profile misuses could eventually prompt stricter warnings, insurance repercussions, or even legal constraints on how features are described in marketing. According to Fox News in the United States, a man dubbed the Tesla road rage driver, Nathaniel Radimac, has been sentenced to 7 years in prison for a violent road rage attack in Honolulu, Hawaii. Radimac, who has a history of similar offenses in Southern California, attacked a mother and her 18-year-old daughter after a verbal altercation while he was driving a gray Tesla. He was charged with unauthorized entry into a motor vehicle and multiple counts of assault, and he pleaded no contest. While this story centers on an individual, not the company, it again links the Tesla brand with viral road behavior, including earlier incidents where Radimac used a pipe to attack other vehicles. For Tesla investors, the direct financial impact is negligible, but persistent association with extreme or antisocial driving behavior can incrementally shape public sentiment, media narratives, and political attitudes toward autonomous and high-performance vehicles. As Tesla vehicles become more common, statistically they will appear more often in both positive and negative headlines. Managing brand reputation through responsible messaging, driver education, and cooperation with authorities will remain an ongoing challenge. According to Kron in Austria, a heated dispute involving a Tesla at a charging station in Wales escalated into a police incident during a local flea market. A Tesla driver who had parked and plugged into a charging point found his car blocked by vendor stalls and merchandise, preventing him from leaving. When he asked an event marshal to clear a path, she reportedly refused. The driver then called the police. When an officer arrived and attempted to speak with the marshal, she allegedly turned her back and resisted, leading to a brief detention. After tempers cooled at the station, she apologized, but still faces a possible charge. Although this is a local story, it underscores how public charging infrastructure is becoming an everyday flashpoint in crowded urban environments. For Tesla and other EV makers, friction around charging access, blocked spots, and event planning will grow as EV penetration rises. These social and infrastructural frictions do not directly hit Tesla's income statement today, but over time they can influence how convenient electric ownership feels compared with gasoline cars. Thank you for listening to Tesla Daily News. If you enjoyed this episode, please subscribe and stay tuned for the next update.